Good morning, all. Hope you are able to hear me.
Yes.
Thanks for the confirmation. So we have completed the definition part and assignment part. Now, as I said, that the important topic is company code global parameters. Already we have, I think you people have written this 10 global parameters. Correct? Write down first one. First one, chart of accounts. Chart of accounts. This is very important. So like majority people are working as an end user here. So people knows that intercompany transactions, cross company code postings. Do you know that intercompany transactions, intercompany postings? Any idea? Hello.
Yes.
You know, right? I'm just asking. I want. Listen, you heard about it, right? Intercompany transaction, transfer of costing and revenues, transfer of costing from one company code to another company code. If I'm not wrong. Yes, right?
Yes.
So write down, first of all, chart of accounts. First is company code global parameters. First point, chart of accounts. Chart of accounts. Write down, chart of account is a, write down, chart of account is a, chart of account is a, chart of account is a, chart of account is a library of GL master. GL master. Chart of account is a library of GL masters. Chart of account is a library of GL masters. Based on this, based on this, we can record all day-to-day transactions. We can record all day-to-day transaction. We can record all the day-to-day transactions of the organization. Day-to-day transactions of the organization. Okay. Day-to-day transactions of the organization.
Library.
Also, we can generate. Also, we can generate all financial reports. We can generate all financial reports related to chart of accounts. Chart of accounts. Related to chart of accounts. Okay. In this chart of accounts, we will have for example, how the hierarchy is. Just write it down this. So chart of accounts. For example, in chart of accounts, so we are calling it as a library. So what does library means? So we will under that account groups. Okay, account groups, we are going to maintain GL masters. This is a higher structure. Chart of accounts, account groups, See here, what exactly I'll explain. So this is the hierarchy. First, chart of accounts. In that, we will create chart of accounts. In that, as I said, the chart of accounts is a library of various GL accounts. So here we need to understand there is a bridge between account groups and chart of accounts and GL masters. So before understanding this particular structure, I would like to, probably Sana knows this. See here, there is in any balance sheet, or profit and loss account, there is a concept called grouping. Manual accounting, we have a concept called grouping and marshalling. There is a concept called in manual accounting. We have this is very important to understand, grouping and marshalling. For example, before understanding what is grouping and marshalling, we need to understand. For example, as we are accounting students or commerce students, and we are working on day-to-day activities, we have a good work experience on accounting. A layman came with a piece of paper. No headings, nothing. Okay. On that particular piece, he has prepared a balance sheet. Clear? He has prepared a balance sheet. He got it from somewhere, and he don't know whether is it related to an individual balance sheet, that is nothing but a sole trader balance sheet, or a partnership balance sheet, or a company's balance sheet. It's a very simple. He has written only capital. That's it, not a share cap. If we have mentioned it as a share capital, then I would have understood. No headings, nothing. Only liabilities and assets, right? And he has mentioned it as a capital on the liability side, and asset side he has mentioned some list of assets, and some on the liability side, some list of liabilities he has mentioned. In that piece of paper, it got mentioned. And he asked us, because we are working on our day-to-day activities on balance sheets, profit and loss accounts and all. So he was asking that, he was expecting the answer from us, that what kind of balance sheet is this, right? Is it a sole trader and partnership balance sheet, or a bank balance sheet, or what do you call company balance sheet? So how we can find it out? How we can make out whether the given balance sheet is a company balance sheet? Because if they have mentioned it as in schedules, then we can know that, then we can make out that is a bank balance sheet, because schedule 10, schedule 11, schedule 12, it will start from schedule 10 onwards, the bank balance sheets. Clear? And he hasn't mentioned anything like schedules and all. Private bank, for example. So he didn't mention even that capital. He has mentioned only as in capital, no schedules, nothing. And same thing in company balance sheet, we know that if share capital, debentures, and all those stuff they have mentioned, then we can consider that as a company balance sheet. But they haven't mentioned anything on that particular thing. And individual balance sheet, if they mentioned it as a balance sheet of Mr. XYZ, then we can consider it as an individual sole proprietorship balance sheet. But nothing has mentioned over there, and just he has given liabilities head and assets head, and he has given us the balance sheet to us, and asking us to make out what kind of balance sheet is this. Is it a sole proprietor balance sheet or a partnership? Sole proprietor and partnership is almost all same. And because in sole proprietor, we don't have a profit sharing ratio. In partnership, we will have a profit sharing ratio. So, but the pro forma and the structure would be the same. And bank balance sheet, normally in the bank, again, I'm telling you, whenever the bank wants to submit their balance sheet to the next level, like RBI or whatever it is, then they will schedule as a scheduled balance sheet. They will have some schedules. But whenever they want to submit their balance sheet to external parties, then they will prepare normal balance sheet only. Normal balance sheet like capital and all those stuff. Creditors, debtors kind of thing only. But when it comes to a company, same. Share capital and all those stuff will be there. But here, nothing has mentioned specifically, like whether it's a bank, sole trader, partnership, or company. How we can make it up? How we can make it out? Okay, so before I would like to go to chart of accounts, I would like to explain this grouping and marshalling in academic accounting part. This is very, very important because as I said that when we go to our consulting firm, like I mean to say client place. So we need to, for example, he is a sole trader firm, but he want to utilize the SAP. He want to implement SAP. And same time you are going to a company and you are implementing two places. You are implementing SAP. One is sole trader firm. He is the only one owner. He don't have any partners. Nor it's not a company, but he want to use SAP in their organization, even though it's expensive. But same time, you are implementing SAP in one particular company. Then how we can make it out? So first of all, we need to understand the concept called grouping and marshalling part. Before we start up with the balance sheet. Grouping, first of all, if you want to write it down also. Grouping means order of writing similar items or you can write like this, or instead of order, keeping similar items of assets and liabilities, keeping similar items of similar nature of items, similar nature of items, assets and liabilities in one particular group is called grouping. See here, what does it mean actually? For example, I am having, if I take assets, I am having bank balance, cash, okay. Next one, sundry creditors, sorry, sundry debtors. Next one, I am having machinery. Okay, next one, computer. Next one, buildings. Next one, closing stock. Closing stock. Loans and advances. And I have some more items called bills receivables. Okay, for example, same on the liability side, I'm having capital, sundry creditors, bank loan, outstanding salaries. Here I'll take it as in prepaid insurance. Bills payable. Next one, incomes, commission received in advance. Just I'm giving simple Okay, so these are the different items. I'm just taking an example. Different items are given. So here cash, sundry debtors, creditors. So here assets and assets, we know what business owns. What business owns means we. Business in the sense we. What business owns are called assets. And liabilities, what business owes are called liabilities. Clear? And these assets are classified into two different types. One is current assets and same time fixed assets. Assets are broadly classified into current assets and fixed assets. So what do you mean by current assets? Okay, everybody knows, but still I'll reiterate. What do you mean by a current assets and a fixed assets? Current assets are nothing but the assets which can be converted into liquid or cash quickly. Okay, the assets which can be converted into liquid in the sense cash only, cash quickly, then those assets are considered current assets. Understood this? What do you mean by current assets? Everybody knows, but still. What do you mean by current assets? The assets which can be converted into cash quickly. So again, one more question here. Quickly in the sense, what do you mean by quickly? So here quickly in the sense, how many days? So it's nothing but 1 year. 1 year. Right? Again, the assets which can be converted into cash within 1 year, then those assets are nothing but current assets. But again, one more question. 1 year in the sense from purchase, acquisition of an asset, or from when? Clear? 1 year in the sense the assets which can be converted into cash from preparation of one balance sheet to preparation of another balance sheet. Right. Normally, preparation of one balance sheet to another balance sheet, we will take 1 year. 1 year in the sense from when to when. So whatever assets we can convert it into cash from preparation of one balance sheet to another balance sheet, from this balance sheet to next year balance sheet, whatever assets we can convert it into cash, those assets are nothing but your current assets. Any questions on this? Yes, no. So for example, we can call it as a cash or cash in hand. So already it is in liquid format. So it's considered as a current asset. Cash in hand, cash at bank or bank balance, cash at bank, bills payable. Bills payable is nothing but your invoices. Sorry, bills receivable. Sorry, bills receivables. Nothing but you have sold customer. You have sold goods or services to customer. So normally, what would be the payment terms? Immediate payment terms we will have 30 days. Generally, I'm taking 30 days pay terms, or we can have 45 days, 60 days, 90 days, 180 maximum, or max to max 240 days, not more than that.
Yes.
Max to max 240 payment terms. So which is nothing but less than 1 year from preparation of one balance sheet to another balance sheet. So cash in hand, cash at bank, bills receivable, sundry debtors. Okay, next one. Sundry debtors. Next is Prepaid expenses. Prepaid expenses. Next one, closing stock. So because whatever stock left out last year, that we are going to sell this year and we can convert into cash this year. Correct. 1 year time we will have. So that's the reason these are the example for current assets. Clear? These are cash in hand, cash at bank, bills receivable, sundry debtors, prepaid expenses, and many more are there. But I have taken few examples. Closing stock. And same time, fixed assets. Fixed assets. What do you mean by fixed assets? These are nothing but opposite to this. The assets which cannot be converted into cash quickly in the sense from 1 year time, from preparation of one balance sheet to another balance sheet. Okay. Then those which cannot be converted, right? Then those assets are considered as fixed assets. Understood? Which can be converted, then these are nothing but current assets, and which are not able to convert. Why? Because we have our business commitments. For example, why building? Can't we sell our building, office building within 1 year? We can sell it, right? Hardly 1 month, 2 months, 3 months. But why we are considering it as a fixed asset, and why we are saying which we can't convert? Because at the time of purchase of building, okay, we want to use for our business. So what we will think? We will think that we want to utilize that particular building for longer period, not for 1 year. We will assume that we are going to use it, going concern concept. We are going to use it for a longer period, as long as our business exists. Clear? Okay. In the meanwhile, if something went wrong and we can sell it, but at the time of acquisition of building, what is the assumption we feel? We assume that we apply the going concern concept rule. As per the going concern concept rule, whatever assets we are going to use for longer period, all those longer period is nothing but more than 1 year. 1 year in the sense, nothing but from preparation of one balance sheet to another balance sheet. Okay. All those assets are considered as an fixed assets. So same thing, machinery I have purchased. So at the time of purchase of machinery, we won't see that it's going to be, we will use only for 1 year. No, we'll use for longer period. So whatever assets we want to use and we are going to use, then that is nothing but your fixed assets. If it is unsuitable and we have sold it, then okay. At the time of purchase, it's considered as an asset, fixed asset. But if it is unsuitable due to some reasons, then we can sell it. Then that is nothing but sale of an asset, but not current asset. So here, fixed assets are nothing but your, again, fixed assets are divided into two different types. One is tangible fixed assets, and second one, intangible fixed assets. So what do you mean by tangible fixed assets? The assets which we can see and touch. Those assets are considered as tangible fixed assets. Tangible fixed assets. Okay. The assets which can be seen and touched, those assets are nothing but your tangible fixed assets. So here again, the tangible fixed assets are, for example, it will start first one. The most tangible fixed asset is furniture. Next one, buildings. Okay. Buildings, machinery, land. Okay, etc. So these are nothing but tangible fixed assets. Okay. Next, again, we have one more asset category, that is intangible fixed assets. Opposite to this. The assets, they are assets, but we can't, the assets which we can't see and touch. Those assets are considered as intangible fixed assets. Okay, in that same thing, trademarks, patents, royalties, and as well as, last but not least, goodwill. Okay, so these are called grouping. See, similar nature of items, see, cash in hand, sundry debtors, prepaid expenses, we are grouping under current assets, right? Same thing, machinery, building, land, and all those stuff, we are grouping under fixed assets, right? So same time, we have on the liability side also, we know that what we owe is considered as a liabilities, and liabilities are again classified into three types. Okay, current liabilities, okay, long-term liabilities, and last but not least, fixed liabilities. Clear? So current liabilities, long-term liabilities, and fixed liabilities. For example, what do you mean by current liabilities? Okay, what do you mean by current liabilities here? Current liabilities are nothing but the liabilities which due for payment, the liabilities which due for payment falls within a year time. That is nothing but from preparation of one balance sheet to another balance sheet. Okay, from preparation of one balance sheet to another balance sheet, all those liabilities are known as current liabilities. Example, the most within a year, whatever payments we need to do, repayments we need to do, all those liabilities are known as current liabilities. The first current liability, the most urgent payment, what we need to do is bank overdraft, nothing but your credit cards. Within 45 days, we need to repay back, right? So there's nothing but bank overdraft, sundry creditors. Now we are no more calling them as in sundry creditors, trade payables, sundry creditors, bills payables, outstanding expenses, incomes received in advance, and accrued incomes. Okay, these all are considered as in current liabilities. Okay, then what do you mean by long-term liabilities? Same thing. The liabilities which due for payment will not fall within a year time from preparation of one balance sheet to another balance sheet. All those liabilities are known as long-term liabilities. Long-term liabilities. For example, normally long-term liabilities are nothing but your bank loans. We have taken bank loan. Normally we will take for 2 years, 3 years, 5 years, 10 years, right? Those kind of loans, bank loans. Okay. So next one, fixed liability. What do you mean by fixed liability? Fixed liability is nothing but after repayment of all liabilities, whatever liability at the end will pay, that liability is known as fixed liability. What is fixed liability? Means, for example, if I say, what we will do first, we will do current liabilities. We will do the payment of current liabilities. And after that, we will do the long-term liabilities. At the end, whatever amount left out, then that will be returned to owner of the business. At the end, not in the starting only, we won't repay him. At the end, after payment of current liabilities, long-term liabilities, then next we are going to pay owner. That is nothing but is capital. So generally, capital is considered as a fixed liability. Any questions on this? I know everyone aware of it, but still, I'm just reiterating because we need to do the chart of accounts. Any questions on this?
No.
Right. So here, this particular part is called grouping. This particular part is called grouping. Then what do you mean by marshalling? I said I have used the term called marshalling, right? So here, marshalling means, this is another important point. Marshalling. What do you mean by marshalling? In the sense, whatever order we have, whatever groups we have created, right? Whatever groups we have created, all assets into current assets, right? Fixed assets, liabilities under current liabilities, long-term liabilities, and fixed liabilities. Then order of writing assets and liabilities in balance sheet. Order of writing assets and liabilities in balance sheet is known as marshalling. Right? So order, how we will write? First, we will take current assets or fixed assets, and liabilities is current liabilities or fixed liabilities. How we are going to take, which one we are going to take first, which one we are going to take last on the asset side. On the same like as liability side, which liability we are going to take first, which liability we are going to take last, right? So we need to follow the specific order. And that order, how we are going to write an order, is nothing but marshalling. That is nothing but marshalling. So how many orders we can write it? Clear? How many orders? The balance sheet can be written in two different orders. One is in order of liquidity. In order of liquidity balance sheet. Liquidity balance sheet. Second one, in order of permanence. Balance sheet. Okay, order of liquidity balance sheet and order of permanent balance sheet. So what do you mean by liquidity order balance sheet? What do you mean by liquidity order? Liquidity order balance sheet. Okay. On the asset side, the most liquid asset, most liquid asset will be shown first. Most liquid asset will be shown first. That is cash in hand or cash. Cash in hand or cash. And closing stock will be shown last. Under current assets. Correct. Whereas the least liquid asset, that is goodwill will be shown last under fixed assets. Okay, what do you mean by liquidity order balance sheet? Liquidity order balance sheet means the most liquid asset will be shown first. So we are not supposed to write whatever we saw in trial balance. We won't prepare our balance sheet. So there is a format of each and every. There are two formats. One is liquidity order balance sheet and another one is permanent order balance sheet. In liquidity order balance sheet, the most liquid asset on the balance sheet. So for example, on the other side, I'll complete this on the other side. On liability side, the most urgent payment, will be shown first. That is that is bank overdraft. If we have, then only bank overdraft, and the least urgent payment will be shown last. That is capital. Okay. So on the liability side, the most urgent payment will be shown first. That is bank overdraft. And the least urgent payment will be shown last. That is capital. Clear? So here, how the balance sheet will be prepared in the sense, if I take balance sheet. Okay, so we have two sides. Liability side and the asset side. So on the liability side, we will make it as an current liabilities, and the asset side, current assets. Okay, current assets. So current liabilities, first one, we will take, as I said, that bank overdraft. Next one, bills payable, whatever. The first, if bank overdraft is there, then we need to take bank overdraft as the first. Bank overdraft, bills payable. If we have any, sundry creditors. Okay. Next one, sundry creditors, outstanding expenses or unaccrued expenses. Okay. Unaccrued incomes, income received in advance, unaccrued incomes, income received in advance. Okay. Bank overdraft, bills, payables, sundry creditors, outstanding, or any other. Next one, long-term liabilities. Long-term liabilities. Long-term liabilities. Under this, bank loans, bank loans, bank loans. Okay. It could be secured or unsecured loans. Next one. Last but not least, fixed liability. Fixed liability. What is fixed liability? Capital. Capital. Or add net, if any net profit, then we will add net profit or deduct net loss. Like this, I'm taking an example. So here on the asset side, cash in hand, cash in hand, cash at bank. Okay. Sundry debtors. Bills receivables. Bills receivables. Prepaid expenses. Prepaid expenses. Unaccrued incomes. Incomes to be received. Accrued incomes. Incomes to be received. Etc. Next one. Okay. Next one we have loans and advances. Means we have given loans to someone. Clear? Next one, fixed assets. Fixed assets. So under fixed assets, the first item would be, for example, furniture. So anything it could be, but furniture, buildings, land or machinery, land. Last but not least, the last should be, we need to show intangible asset. That is nothing but goodwill. So this is considered as an order of liquidity format. Means the most urgent payment will be shown first and the least urgent payment will be shown last. The most liquid asset will be shown first on the asset side and the least liquid asset will be shown last. So this is called liquidity format. And who will follow this particular format in the sense, which organizations, what kind of firms will follow in this particular format in the sense, sole trader firms, means individual firms. Sole trader firms will follow this balance sheet. Partnership firms will follow this firm. Partnership firms next, and banks will prepare their balance sheet in order of liquidity. Clear? Sole trader firms, partnership firms, banks will follow their balance sheet in order of liquidity. Next one, what do you mean by next order? This is next order. We have order of liquidity, liquidity order. Next one, permanence order balance sheet. Permanence order balance sheet. Order balance sheet. So who will follow the permanent order balance sheet in the sense? Opposite. So here what we said, on the asset side, the most liquid asset. So here I'll just change it. On the asset side, the least liquid asset. The least liquid asset will be shown first. That is on the current asset, that is goodwill. Goodwill and sorry. On the asset side, the least liquid asset will be shown first. That is goodwill. That is goodwill on the asset side. And the most liquid asset will be shown last. That is cash in hand. Cash in hand. Whereas on the liability side, the least urgent payment will be shown first. That is capital. And the most urgent payment will be shown last. That is bank overdraft. Clear? And who will follow? The order is completely different, opposite. Means in order of permanence, first fixed assets, under fixed assets, first one would be goodwill, order would be reversed. And after that, loans and advances, and after that, current assets, under current assets, last would be, for example, if you have any stock, okay. So the order first stock, and at the end, in the current asset, cash in hand. The order would be opposite. First fixed assets, under fixed assets, first item would be goodwill, and after that land, machinery, or anything you can, but last should be furniture. Okay, if it is there, then loans and advances, heading it would be loans and advances, and after that current assets, under current asset, your stock would be the first item, and last item should be cash in hand. Okay, when it comes to liability side, first fixed liability, that is nothing but your capital, and after that heading would be long-term liabilities, and after that current liabilities. Under current liabilities, first anything, but last item should be bank overdraft. Clear? Any questions? And as per Companies Act 1956, as per Companies Act 1956, as per Companies Act 1956, every company means here I'm talking about registered. Every company has to prepare their balance sheet, in order of permanence. Clear? So, who will prepare their balance sheet in order of permanence, in the sense all companies will prepare their balance sheet in order of permanence, and rest other, apart from companies, all other firms will prepare their balance sheet in the form of liquidity format. So if someone has given you on a piece of paper some balance sheet, first we need to check the order, what kind of order it is. If it is current assets are first and last fixed assets, current liabilities are first and fixed liabilities are last, then nothing but it could be either bank balance sheet or a permanent partnership balance sheet or sole proprietor balance sheet, not a company balance sheet. That you can say it's not a company balance sheet. If it is permanence, that is nothing but on the liability side, fixed liabilities first and current liabilities are last, and same time fixed assets and the assets at fixed assets are first and the current assets are last, then that is nothing but permanence order. So that is 100% company's balance sheet. Is this clear? Any questions on this? Any questions? Yes, no.
No, sir.
So here, so why we have taken in this is, see here, this is nothing but we said that, see here, we wrote it as an, what is chart of accounts? Chart of accounts is a library of account groups. So here we said that account groups and GL masters. So here, what are account groups? Account groups are nothing but your like current assets, fixed assets, tangible fixed assets, intangible fixed assets. Those are considered as an account groups. These are clear. And what are the GL masters? Whatever accounts are there in the transactions, whatever accounts involved in a transactions, those are considered as in GL accounts or GL masters, GL account masters. For example, if I take a transaction, okay, so if I take a transaction, purchased computer for cash 10,000, right? So here, how many accounts are involved? GL accounts are involved in this particular transaction. One is computer, one account, correct? And what is the other account is involved? Cash account. So these are called GL accounts or GL masters. But a computer comes under which account group? You remember, right, in books of accounts in the initial stage, we will classify the accounts, classification, right? So that particular part. So computer comes under, for example, we are going to consider it as a fixed asset, and cash comes under current assets, right? So these are called account groups. These are called, so for example, what are the accounts involved in this particular transaction? Computer and cash, right? So computer is one account, is GL account. So we are classifying GL account, and as well as cash is also one account, GL master, right? But which account group? Computer comes under an account group called, for example, fixed assets, and cash comes under account group called current assets. Clear? Any questions here? So here, first of all, so we need to store this account groups and GL accounts. Where we are going to store in our SAP, we are going to store under chart of accounts. Chart of accounts is nothing but chart of accounts is nothing but, as I mentioned, it as a library of accounts. So library of GL accounts, right? It's nothing but a list of accounts which are involved in the business for each and every transaction, right? So all accounts will be stored under account. First, all individual GL accounts, ledger accounts will be stored under, classified under account groups, and those account groups will be stored under chart of accounts. Is this clear? So how is the hierarchy? Chart of accounts means we are going to create one chart of accounts. For example, what is our company name? What is our company? What is our company code? Sorry.
Birla.
Birla, right? So I'm going to create BOCA. Birla, I'll tell you what is BOCA, Birla Operational Chart of Accounts. Okay. So we are going to create one chart of account name, Birla Operational Chart of Account. And we have a different types of chart of accounts again, right? Country specific chart of accounts, operational chart of accounts. Next one, group chart of account. So in tomorrow's sessions, we are going to discuss this. Right, we are going to create one chart of accounts, and we are going to create account groups, different. In general, people will create, the consultant will create only 4 types of account groups. One is, as we mentioned, assets, liabilities, expenses, and incomes. In general, outside, what I saw from other training institutes, they are going to create only 4 account groups because the work is easy if we create 4 account groups. But here, I'll get whatever possible account groups, whatever possible account groups are there, that we are going to create here. And after creation of account groups, we are going to create GL accounts. Is that clear, everyone? Any questions in this?
No.
Okay. Any questions before we proceed to the next? Any questions on this? Okay. Tomorrow sessions, we will see how to create a chart of accounts. Clear? And how many types of chart of accounts. Just before chart of accounts, we need to understand the account groups part. So that's the reason I have came up with grouping and marshalling part, and how many ways we can prepare a balance sheet and all those stuff. Okay. So tomorrow we will see. Already we have started what is the introduction of chart of account, what is the definition of chart of accounts. So tomorrow we will see how many types of chart of accounts can be prepared, which one we are going to, because on the base of chart of accounts only, we can do intercompany transactions. How we are mapping our chart of accounts. So on the base of that only, a company, see, majority companies will have intercompany transactions. When it is possible to do intercompany transactions, which methodology if we follow chart of accounts, what kind of methodology if you follow chart of accounts, then intercompany transactions are possible. Clear? So that we will see in tomorrow sessions. Any other questions? Yes, no?
Yes.
Okay, then we'll see in tomorrow session. Thank you all.
Thank you.
Thank you. Tomorrow at 7:30.
Yeah.
Yeah, thank you.